Yes, hello and welcome guys and welcome to this session of valuation. And yes, we are on to the second chapter of our valuation syllabus, which is mergers and acquisition. And I must have told you earlier also guys that this chapter will command a very good percentage of marks in your examination. I mean, if I were to say that what is that one chapter which is going to be really of paramount importance in your examination, that will be this chapter. So out of 50 marks of BVM approximately, 20 marks paper will be from merger and acquisition. Yes, almost 30 to 40% of BVM paper is from valuation of merger and acquisition. Every time, each year this is the trend that from merger and acquisition chapter, almost 40% paper is from merger and acquisition, 30 to 40% paper. So yes, this chapter is really important from an exam standpoint. Its concepts are important. Its questions are very important, and therefore you can actually see that this is the only chapter in which we have so many practice questions. Yes, in chapter number 1 also it was there, and similarly this chapter. So actually these two chapters are the the key chapters of our syllabus. So very important from an exam standpoint, valuation in mergers and acquisition. And I hope that you are continuously, along with your classes only, completing the entire chapter, doing the questions on your own in the register. That is the important key point to complete this chapter. Okay, sir. So yes, in the last class we had seen basics of merger and acquisition. What do you mean by merger and acquisition? What are the reasons of merger and acquisition? Why does merger and acquisition happen in any country or in any company? What are the factors that are responsible for merger and acquisition? Why are merger and acquisition happening in the country? I mean, what are the benefits of merger and acquisition? All these things we had seen in our earlier class. Good morning everyone. Yes, welcome to the live session. All right. So yes, in the last lecture we had seen multiple reasons why merger and acquisitions happen. We had seen the history. History means, since independence of India, what has been the trend in economy and why merger and acquisition have become so popular in last decade or last 2 decades, why merger and acquisition has become so vibrant and so important, that we have seen in our last class. Last class also introduced you to the concept, the very basic concept of swap ratio. Okay, swap ratio is one such concept which we'll be using again and again repeatedly in our deliberations and repeatedly in our examination. This concept will be used of swap ratio. Okay, before we go any further, let us also go through the charts which we had not gone through yesterday, and let's see the concepts in brief of merger and acquisition. So first and foremost is difference between mergers and acquisition. What is the difference between mergers and acquisition? Merger means when two companies join hands to form another company. In this entire process, both the existing company will lose their identity. They will not have their independent identity, or at least one of the companies will lose their identity, and the new company will be formed, which will be a new identity kind of a company. However, in case of acquisitions, when both the companies merge together, not merge together, but one company acquires the shares of another company, both the companies remain intact and both the companies' identity is secured. The company doesn't gets vanish, doesn't gets off. So that is the peculiar feature of acquisition, that after acquisition both the companies are specifically their existence is there, their identity is intact, their identity is not compromised. That is the case of acquisition. So mergers and acquisition, these are the two distinguishing terminologies, but I have already told you that according to guys valuation of merger and acquisition chapter, it doesn't matter whether it's a merger or an acquisition, whether one company is getting diluted, other company is not getting, we don't care, because the calculation will remain the same for acquisition, for merger and any kind of merger. Yes, I know that if you have studied CFR, you must have studied that amalgamation, merger, acquisition, all three of them have different kind of accounting treatments. Okay, so you need to remember that this accounting treatment is in this case, this accounting treatment is in this case, but not in case of valuation. We valuers are not bothered how are you merging a company into another company, or how are you acquiring a company into another company. We don't bother at all. We don't care. All we care about is that companies are getting merged, so we need to find the purchase consideration, we need to find the swap ratio, we need to find the purchase price premium. This is what we are concerned with, and that is exactly what we are going to do in this particular lecture. So yes, two definitions, two distinctive definitions. One is of merger and another is of acquisition. When two companies combine together to form one company, it is termed as merger of the companies. The two companies end to exist and new company is formed. So ideally, technically, the merger is a situation where two companies combine together and make a single company out of it. However, in case of acquisition, the acquiring company take over the majority stake in the acquired company. So the majority stake is taken over by the acquiring company in the acquired company, and the majority stake is valued. Acquiring company continues to be in existence. So the point to be noted is that acquired company and the acquiring company, both the companies, bidder company and the target company, both continue to be in existence. Both are there in existence when acquisition happens. So acquisition and mergers have got two different definitions, but their computation is very similar as far as valuation is concerned. Both of them have swap ratio. Both of them will be subject to purchase consideration calculations. Calculations are pretty much the same. Okay, this is just to tell you the difference between both of them. So Vodafone and Idea actually merged together to lose their individual identity, and they made a new company known as Vodafone Idea. So now their individual identities have been merged, and now there's a single company called Vodafone Idea. There's a possibility that the future generations would not even know that Vodafone Idea were two separate companies. They would always think that Vodafone Idea is one company, that's one telecom player, the future generations. Okay, so yes, both the companies would lose their individual identity and they will form one single entity that will persist, which is Vodafone India in case of merger. However, in case of acquisition, whenever a company acquires another company's stake, then individual entities are retained. For example, Facebook acquired stake in Instagram, in WhatsApp. So all the three are now actually under a single umbrella, but all the three have different identities. Okay, none of them have lost their identity. Their true identity is not lost by any of them. All of them retain their identity. So all three of them are individually retaining their identity. That's how acquisition takes place. Okay, so in case of acquisition, the acquiring company takes over the majority stake in the acquired company, and acquiring company continues to be in existence. That is the concept of mergers. Yes, we are also already we have already studied this concept. Types of merger. There are three primary types of merger. Number one is the horizontal merger, where two companies which are in the same line of business merge together to form another company. That is horizontal merger. Then we have vertical merger, where two stages of production are merging together. So one is pen manufacturing, other is refill manufacturing. Both these companies join hands, they merge with each other. That's vertical merger. Vertical merger will result into acquisition of the entire product line, entire product chain. So we have better control over the entire production process. That's how we gain efficiency. Finally, the conglomerate merger, there is no relationship at all between the company who's getting acquired and between the company who's acquiring. There's no correlation, there's no coexistence, there's no connection or similarity or relationship between the two. But just to diversify the business, the entity is being merged. So I'm into education sector right now. But I want to be into AI sector as well. I want to develop AI tools, artificial intelligence tools. So I'll acquire another company totally unrelated to my existing business. That will be termed as conglomerate merger. That's known as the conglomerate merger. And vertical merger has two different sectors to it, backward integration and forward integration. Whenever you move towards the customer, okay, so there's an ice cream manufacturer who buys a restaurant to serve the customers. So that's a forward integration. And if the same ice cream manufacturers buys farms where milking happens, where cows are there, so that he gets access to fresh milk every day, then it is a backward integration. So vertical merger has two sections, backward integration and forward integration. So these are the three types of mergers which are there in vogue, and you should understand the technicalities of all three of them. So yes, a very good example of a horizontal merger and a vertical merger. In case of a horizontal merger, two companies with similar goods or services join hands. For example, General Motors and Ford. If those two companies merge together, it will be termed as horizontal merger, okay? Because both of them are in same line of business, which is automobile. What is vertical merger? Vertical merger means where General Motors acquires Goodyear tires, okay, or Seat tires, Goodyear tires or Seat tires. So General Motors is into automobiles. Now they want to acquire a company which manufactures tires so that the efficiency or the synchronity is increased. Therefore, this will be known as the vertical merger. Or General Motor can also acquire any auto dealers. General Motor might say that I want my showrooms to be there in entire Delhi, entire India. I want my own showrooms to be there. General Motor might say this. So General Motor, when it acquires auto dealers, showrooms in the entire country, then it is an example of a vertical merger. Okay, so horizontal merger and vertical merger both are, types of mergers. Finally, the motives behind mergers. There are various motives behind mergers. What drives merger is your own motive, your own reason why do you want to merge. The first and foremost reason is people want faster growth. If internal capabilities are developed, they are, marketing skills are developed, market size is developed, then it will take a lot of time to grow. So if quick growth is required, then guys, people resort to mergers and acquisitions. So faster growth, rather than internal capabilities, we grow faster in case of merger and acquisition. Synergy benefits. Synergy benefit is one very important motive which people chase. People would look for efficient ways of doing things. People will look for more efficient, tools of doing things. People would want things to become little more profitable to them, and therefore the merger and acquisition happen. So, a very good example of this is that whenever we buy something, okay, so I'm a teacher, I buy, say 100 pen drives from a vendor. There are 10 teachers who work along with me for selling their combos, right? Now, what if 100, all 10 of us go together to the vendor and we purchase 1000 pen drives? If we join hands and we purchase 1000 pen drives, of course, it will be cheaper. Economies of scale will kick in. That's exactly the synergy benefit. So, synergy means that 1 plus 1 has to be little more than 2. It cannot be 2. It cannot be 2. It should be more than 2. It can be 3, it can be 4, it can be 5, it can be 6, it can be 7. In Hindi language, there's a very old saying, ek aur ek 11, the power of strength of unity. And that's exactly what is demonstrated in merger and acquisition. So I've also told you in the last class, guys, merger and acquisition is useless if 1 plus 1 is not equal to 3. Then merger and acquisition is useless. We have seen, this equation being true. So synergy means where 1 plus 1 is equal to 3 means two firms combining together. First firm's revenue is 10 crores, second firm revenue is 20 crores. If the combined firm's revenue is 30 crores, merger is useless. Don't do that merger. The combined revenue has to be more than 30. It has to be 32, 33, 34, 35, whatever, but more than 30. And that's exactly what's known as the synergy benefit. So whatever extra we get in a merger and acquisition deal is known as synergy, and that is the whole point of merger and acquisition. That is the whole point. We want to earn more. As a human being, we are greedy. We want to earn more. And merger and acquisition ensures that when two organizations come together, they reap additional benefits. They reap benefits of large economies, large scale operations. They reap benefits of economies of scale, etc., etc. So we want synergies to kick in, and soon as synergies kick in, we try to cash in those synergies. So that is the whole point of merger and acquisition, synergy. Third one is to gain bargaining power. Of course, I gave you an example that if collectively people do business, then their bargaining power increases. If a person is holding the entire supply chain, okay, entire product chain of whatever he's manufacturing, like if I own the softwares that I provide to you, I hire a software engineer and software experts, and they provide me softwares which you are using, okay, that's the current scenario. But what if I own these softwares also? Then they're under my control. They'll be cost effective, number one. Number two, they'll work according to my will, according to my interest, and according to my needs. They will work. So it will result into a lot of bargaining power, a lot of control I will gain over my entire production process. So entire production process will be beneficial in terms of the bargaining power. So bargaining power increases in case of merger and acquisitions. Then unique capabilities and resources are developed. So this is one very important benefit of merger and acquisition, that when you resort to merger and acquisition, when you resort to merge something, then you sometimes acquire some unique capabilities which you do not have internally, and you don't want to develop them internally because it will take time. I gave you an example in the last class. I want to establish my own R&D center, my research center. I want to hire scientists in those research centers. Now, to establish a research center, it will be costly, number one. Number two, it will be time taking. I'll take a lot of time to establish a research center. A shortcut will be just to buy an existing research center which is already in existence. I just buy it. So it becomes an alternative to develop capabilities internally. We need not develop the capabilities internally. We just purchase the capability. That's how this works. Then of course, diversification is a very important motive behind merger and acquisition. If we diversify, if we we expand our production lines, we expand our work, we expand the nature of line of business, then it gives a huge benefit. If one business is not doing that well, other will do well. If one product is not doing well, other will do well. So the probability of averaging out is increased if we diversify our businesses. Why do people have so many businesses? Why do they venture into so many businesses? The reason is very clear. They want averaging effect. Averaging effect means if some business is not doing well in some part of the year, other will do. If other is not doing well, then other will do. So you have that averaging effect, and therefore the conglomeration or diversification is one of the very important tools of merger and acquisition. Expansion of the product lines is the ultimate target. Okay, so these were the motives of mergers and acquisitions, and we had seen these motives in our last class, right, sir. Then we had seen the purchase price premium, and we concluded on the swap ratio. Okay, we concluded on the swap ratio. What is swap ratio? Swap ratio means a number of shares which are exchanged for one share of the target company in the bidder company. So swap ratio is the concept that we did yesterday. Swap ratio is the concept that we did yesterday. Okay, so swap ratio. I hope you remember the formula of swap ratio. Yes, sir, we do remember. The parameter of the target company should be on the numerator. The parameter of the bidder company should be in the denominator. Always remember this technique, that target company will always be in the numerator. Target company will also always be on the target. Target means the numerator. So EPS or MPS or EPS or MPS or BVPS or any other parameter of the target company divided by EPS oblique MPS oblique BVPS or oblique NAV of the bidder company. This is the formula that we use for swap ratio. So swap ratio or exchange ratio is one and the same thing, and we use this formula to compute the exchange ratio. How many shares of the target company should be exchanged in giving the shares of the bidder company. That's how the exchange happens. That's how the exchange ratio takes place. So exchange ratio or the swap ratio is one of the most important key ingredients of our entire concept of calculating the purchase consideration, and that is one of the most important things. Okay? Now we start our next topic today, and the next topic that we need to discuss today is the new earnings per share. The next topic that we are going to start today is the new earnings per share. The new earnings per share. Okay, so there are two companies, A and B, and I am giving you some information about A and B. Let me give you some information about A and B. Okay, so profit after tax of both the companies is, A company is 2 lakhs, B is 1 lakh. Number of shares of both the companies is, A is 10,000, B is 5,000. Okay, so if I were to ask you what is the existing earning per share of both the companies, okay, if I were to ask you what is the existing earnings per share of both the companies, you will tell me that, sir, the existing earnings per share of both the companies is 2 lakh divided by 10, which is 2, and 1 lakh divided by 5,000. 1 lakh divided by 5,000. So earning per share is constant for both of them. Okay. Okay. So EPS is constant for both of them. 20 and 20. 20 and 20 is the EPS for both of them. Okay. So now when we talk about the earning per share of the existing companies, both the companies have an earning per share of 20 and 20. That's the earning per share of both the companies. That's the existing data which is given to you in the question. Okay. Now, A company is planning to acquire B company. A company is planning to acquire B company. A company wants to acquire B company. And the swap ratio, which is decided, is 2:3. The swap ratio which is decided is 2:3, which means for every 2 shares, for every 3 shares of the target company, the bidder company will issue them 2 shares. For every 3 shares of the bidder company, of the target company, the bidder company will issue 2 shares. That's how the swap ratio is 2:3. So the swap ratio is computed as 2:3. Now one more information is given to you, that after merger of both the companies, the synergy benefit which will accrue to the companies is, the profit after tax will increase by 50,000. There will be an increase in profit after tax by 50,000. This is a share exchange, the share exchange method is to be used to actually fund this particular merger. So the numbers are pretty clear. Okay, profit after tax is given to you, number of shares is given to you for A and B, and their existing EPS is also given to you. Okay, existing EPS is 20 rupees. Okay, how is it computed? 2 lakh divided by 10,000, 1 lakh divided by 5,000, 20 rupees. Swap ratio already given in the question, 2:3. 2:3 means whatever the number of shares of B Limited, we multiply it by 2 and divide by 3. Okay, this is the target company. B is the target company and A is the bidder company. That information is already given to you in the question. Now, what is required? Okay. Now, what is required? What is required? Requirement is, what is the new earning per share? The requirement is, what is required to be calculated? Required is, what is the new earning per share post merger? What is the new earning per share post merger? After merger, what will be the new earning per share? That is the requirement. When these entities will merge together and B will be incorporated in A, so A will be the bigger A, okay, the bigger A or the post merger A. What will be the new earning per share post merger? What will be the new earning per share post merger? Now, before coming to the new earning per share post merger, I would like to ask you, what is the formula of earning per share? So the formula is very simple. Earnings attributable to the equity shareholders divided by the number of shares. Simple, right? Earnings attributable to the equity shareholders divided by the number of shares. That's it. That is the the formula. I agree with the formula. Now let us develop the formula for new earning per share. Okay. Now guys, the formula for new earning per share will of course have a EAT, earnings after tax, of, first of all we have A Limited, right? The earnings after tax of A Limited is the bidder company. So the combined firm, which is A Limited, will first have the element of earning after tax of A Limited. Then the second element which the merged entity will have is EAT of B Limited. EAT of B Limited is the second addition that we do. So EAT, earning after tax of A Limited, plus earning after tax of B Limited, plus the combined firm will have something more. It will not only be the existing earnings of A Limited and B Limited, it will have something more. Now you tell me in the chat box, what more? What more will be there in the merged entity? What more will be there? What else will be there in the merged entity? What extra will be there In the perfect answer, very good answer, perfect guys. One more thing will be there, which is not there in the existing organizations. It will be the synergy benefits. It will be the synergy benefits. Correct. 50,000 rupees worth of synergy benefits will be there post the merger. So we'll add synergy benefits to our computation. Now you write in the chat box what should be the denominator. What should be there in the denominator? Please write in the chat box. Just think about it and then tell me. Okay, so can you guess what will be the denominator? Okay, you've given me the answer and that's good, but I want to know the formula first. So the denominator will first of all have the shares of A Limited. Okay, the existing shares of A Limited, whatever are the existing shares, the current shareholders of A Limited, which will remain intact in the new organization, in the combined entity. The denominator will first of all have the shares of A Limited, which is the existing entity. Okay, then now we will have new set of shareholders in A Limited. Okay, and those shareholders will be the shareholders of B Limited, but they will not come as it is. They will not come as it is. They will be multiplied by the swap ratio, and then we will understand the new number of shares which will be issued by A Limited to B Limited shareholders. So now when we write the shareholders of B Limited, we open a bracket and we say that shares of B Limited multiplied by the swap ratio. That's the bracket which we make. Okay, so B Limited shareholders will now be converted into the A Limited shareholders, and B Limited shareholders will have access to A Limited, and A Limited will be giving them shares in the ratio of swap ratio. Not entire shares of B Limited will form the shareholders of A Limited. That will not happen. Entire shares of 5,000 will not become the shareholders of A Limited, but only proportionate. In what proportion? In the proportion of swap ratio. That's how the mathematics will work. Okay, so now let us compute the answer, guys. EAT of A Limited. EAT of A Limited is 2 lakh rupees. Then we have EAT of B Limited. EAT of B Limited is 1 lakh rupees. Then we have the synergy benefit. Synergy benefit is 50,000 rupees in this case. We divide all of this by the new number of shares. New number of shares will be shareholders of A Limited, which is 10,000, plus shares of B Limited, which is 5,000, multiplied by the swap ratio. The swap ratio is 2:3. The swap ratio is 2:3. So we have 50,000 multiplied by 2 divided by 3. We have 33,333. 33,333, and 10,000 shares are already there of 5,000. Okay, 3,333. So what is the resultant figure? Resultant figure is 20,000, 30,000, 50,000, 80,000, 2 lakh, 2,50,000, 2,50,000 whole divided by 13,333. So we have 2,50,000 divided by 13,333. The new earnings per share is 18.75 per share. The new earnings per share is 18.75 shares, the new earning per share. So yes, the new earnings per share is lower than the existing earnings of A Limited. Of course, guys, when you will give your shareholding to new number of shares, the new people are joining in, and your profits are not increasing as much, profits are only increasing by 50,000, and the new shareholders are joining in, then obviously there has to be some, okay, yes, my mistake, yes. This is 3,50,000. Yes, this is 3,50,000, not 2,50,000. So it is 3,50,000 divided by 13,333. So the new earnings per share is 26.25. The new earnings per share is 26.25. It's not 18.75. It's 26.25. Yes. So the new earnings per share is 26.25. So yes, that's how the new earning per share is to be calculated. Now, a very simple way of doing it is just mug up the formula. Earnings of the bidder company, earnings of the target company plus synergy benefits divided by number of shares of bidder company plus number of shares of target company multiplied by the swap ratio. Just mug up the formula. But it's better to understand the formula bit by bit, because questions will challenge my understanding of the formula a lot. Question will give me a lot of challenging situations. So let's start some challenging situations which now questions will give me regarding the new earnings per share. So let's study what is new earnings per share. NEPS refers to the earnings per share available to the shareholders post merger. So whatever is the earnings available to the shareholders post merger, that is known as the new earnings per share. Following formula may be used. What is the formula? Earnings of the bidder company, which is pre-merger earnings, plus earnings of the target company, which is the pre-merger earnings of the target company, plus the synergy benefits. Whatever are the synergy benefits, we add on to it. So these three things add on together. That will be the earnings available post the merger. After merger, the earnings available is total of earnings of bidder company, earnings of target company, and the synergy benefit, divided by shares of the bidder company plus shares of the target company multiplied by the swap ratio. That's the formula for new earnings per share. In case synergy benefit is not given in the question, it may be assumed as 0. So it depends whether synergy benefit is given to you in the question or not. If not, assume it as 0. Let's start one very easy question. Okay, very simple question, examination question. Illustration number 3. A company X is contemplating purchase of another company Y. So company X is the bidder company. Company Y is the target company. Company X is having 6 lakh shares outstanding. So company X has 6 lakh shares outstanding, having a current market price of rupees 50 per share. So 6 lakh are the outstanding shares of the bidder company, and the current market price is rupees 50. While company Y has 4 lakh shares outstanding, having a current market price of 25. So Y company also has 4 lakh shares, and the current market price of Y company is 25. The earnings per share of company is rupees 4, while that of company Y is 2.25. So EPS is also given to you. EPS is 4 and EPS is 2.25 of company X and Y respectively. Company X is in consultation with company Y is considering the following two alternatives to determine the exchange ratio. So exchange ratio is also determined by using the following things. Number 1, in proportion of their relative EPS. Okay. So first alternative is in the proportion of EPS the exchange ratio can be determined. Then in the proportion of current MPS, on the basis of MPS the exchange ratio can be determined. Now you tell me in the chat box which one is a preferred option, which one is a better option, EPS or MPS for computing the swap ratio. You tell me in the chat box which one is a better option. Suggest which alternative way company X should use to determine the exchange ratio so that after merger increase in EPS of company X is higher. Now company X, which is the bidder company, wants to know which method of computation of swap ratio will give a higher EPS, which will give a higher EPS that should be post merger EPS should be higher. That is considered by the bidder company X. Okay, please tell me in the chat box which is better, swap ratio on the basis of EPS or swap ratio on the basis of MPS. Which one is better? Please tell me in the chat box. Okay. Now my suggestion to all of you, before you start any such questions where there are multiple metrics which are given to you, okay, like you are seeing in this question, there are multiple metrics which are given to you. Shares outstanding is given, price per share is given, shares outstanding is given, again price is given of both the companies, EPS is given for both the companies. So there are multiple parameters which are given. Whenever such a question is given, the first step that you should do is to arrange the data in a table so that you are able to pick up the data well. Don't just start the question immediately. Just arrange the data in the table. So you make a table and you arrange the data given in the table. So number of equity shares is to be taken, first of all, company X 6 lakhs, company Y 4 lakhs, company X 6 lakhs, company Y 4 lakhs. What is the MPS? 25, 50 and 25. 50 of company X, 25 of company Y. EPS, what is the EPS? EPS of X is 4 and 2.25. 4 and 2.25. 4 and 2.25 is the EPS. Okay. So these are the matrix which are given in the question. I have arranged these matrix in a tabular form. Always do. Yes, very good answer. Very good answer. None of them is better. Neither EPS nor MPS. Both of them can be used depending upon the situation, depending on the circumstance. You can use whichever you want to do, whichever you want to use. None of them is better or none of them is worse. That's the answer. That's absolutely correct. Okay, so in the ratio of okay, now we have arranged all the matrix in the table. Now we for sure know one very important stuff, guys, because we need to find the new earnings per share. So we know that we want the individual earnings of both the companies, total earnings, not the EPS. So one calculation that we do over here is we compute the total earning, because we know that this figure will be used in our future calculations. So we do it here itself. So how would we know in the examination what all calculations are to be done which will be used in future? Guys, that will be based on your practice. As much as you practice the questions, you will be able to, your gut feeling, your sixth sense will tell you that yes, this is required to be calculated. Your sixth sense will tell you, don't worry about that. Okay. So I'm calculating the total earnings. Total earnings means 1 multiplied by 3. 1 multiplied by 3. So I'm calculating the total earnings. Okay. So please calculate the total earnings, because they'll be used in calculating the post-merger earnings per share. So this will be 9 lakhs. This will be 9 lakhs. Post-merger earning per share is 9 lakhs. Okay, so this is the total earnings which we have calculated for a future calculation. So step number 1 in all such questions, whether it's from a chapter of merger and acquisition, whether it's from valuation basics, whether it's from valuation of shares, goodwill, whatever chapter, the first and foremost thing that you need to do, where multiple data points are given to you, multiple matrices are given to you, you have to arrange the data in a table for both the companies so that we can extract the data well. Okay, so always make this table of data given, then you start your answer. Okay, now what is the ask? The ask is that you need to compute the company X's consolidation Y is considering following two alternatives when determining the exchange ratio. You need to compute the new earning per share and suggest where the increase in EPS is higher. So you need to compute the new earning per share based on both the swap ratios. First based on EPS, second based on MPS, and then you need to comment which one is better according to company X. Okay, sir. So first let's compute the new earning per share on the basis of relative EPS, earnings per share. Okay, always the formula is used is, okay, please write the bidder company and target company also over here so that we don't confuse it. Okay, always the catch is, or the key is that you write the EPS of the bidder target company in the numerator. So EPS of the target company divided by EPS of the bidder company. So target company's EPS is always on the numerator and bidder company's EPS is always on the denominator. So earnings of company X plus earnings of company Y. So 24 lakhs is the earnings of company X. 9 lakhs is the earnings of company Y. Is there any synergy benefit which is given in the question? Answer is no. There is no synergy benefit which is given in the question. And in the denominator, you will write number of shares of company X. What is the number of shares of company X? It is 6 lakh shares of company X. Okay. Then what is the existing shares of company Y? It's 4 lakh shares of company Y. Okay. The target company has 4 lakh shares. Now we multiply it by the swap ratio. Swap ratio is based on the earnings per share. Earnings per share is 2.25 divided by 4. 2.25 divided by 4 is the swap ratio which is there. Okay, 2.25. So that is how you always write your answer. First write the formula. Complete formula is required to be written. Okay, so you write the complete formula and then you write the numbers and then you write the answer. So this is the way the answer is to be done in the question also. Now you guys compute the new earning per share. You guys compute the new earning per share. Please let me know what is the new earning per share. All right, very good. I've got two answers. I've got two answers on the basis of EPS. So 24 lakhs plus 9 lakhs divided by 8,25,000. Answer is 4. What is the new earning per share? New earning per share is 4. What mistake have you done, guys? Why is your answer 4.125? The answer is 4, not 4.125. The answer is 4. The new earning per share is 4 on the basis of existing EPS. If we take the existing EPS as the basis for swap ratio, EPS is 2.25 and EPS is 4. This is the ratio on the basis of relative EPS. Why is your answer 4.125? Tell me. No. Swap ratio is first, the swap ratio is on the basis of relative EPS. The first option is, no, this is the second option, 25 by 50 market price per share is the second option. The first option is that we need to compute the swap ratio on the basis of relative EPS, earnings per share. This what you are computing is the second part of the answer. Guys, swap ratio can be computed in many ways, right? Swap ratio can be computed in many ways. In the first part, we are using the relative EPS for the basis of swap ratio. And the relative EPS is 2.25 and 4. That's the mistake that you've done, because of which your answer is not correct. I got it now. Okay, got it. So on the basis of EPS, the EPS is 4. Earning per share is 4. Now let us compute the new earning per share on the basis of the relative MPS, market price per share. Okay. Yes, the same formula is required to be repeated. Earnings of company X plus earnings of company Y plus synergy benefit whole divided by shares of company X plus shares of company Y multiplied by the swap ratio. Same formula to be repeated, and yes, many students will ask me, sir, if we use the formula once in one of the questions, then you need not repeat it again. Absolutely right, guys. I agree. Once you write the formula once, you need not repeat it, but I have written it because there's no harm. I'm not losing on time, no. If you're losing on time, then don't repeat the formulas again and again. Just write one formula once in the entire answer, and that's all. That's it. And this time the swap ratio will be on the basis of the market price per share. So 4 lakh multiplied by 25 divided by 50. 4 lakh multiplied by 25 divided by 50. This time the swap ratio will be based on the market price per share. In the last part, the swap ratio was based on the earnings per share. That's the difference. Now let's compute. Yes, you've already computed this part. 4.125 is the swap ratio. Is the new EPS. So new EPS, when market price per share is taken as the basis, is 4.125, and new EPS, when EPS is taken as the basis, is 4. So 4 and 4.125. So that's how the new earning per share will be calculated. So second part, the new earning per share will be 4.125. The first part, the new earning per share will be 4. This is the new earnings per share. 4 and 4.25. Okay. Now the question is asking us one very critical question. Suggest which alternative way company X should use to determine the exchange ratio so that after merger increase in EPS is higher. So guys, after merger the increase in EPS will be higher in case the exchange ratio is taken as MPS. MPS, if you take the exchange ratio as MPS, then your after merger earning per share will be higher. Earning per share is 4.125 after merger if MPS is taken as the basis. And we have written this as the conclusion. Yes, the only point is that this conclusion should be divided into two parts. First, the main answer, that the NPS is calculated as 4 and 4.125 respectively. The next paragraph, in the next paragraph you should have written that the yield will be higher, the EPS will be higher in case the exchange ratio is based on the MPS for company X. So two paragraphs should have been created so that presentation as well, but this is also okay, guys. Okay sir, got it. If you understood the question, please write a yes in the chat box so that we can start in the next question. Yes, very interesting question, huh? Let's start the next question. If you understood question number 3, Please write a yes in the chat box so that we can start the next question. Yes, yes, very good, perfect. Are you finding the chapter easy? Please tell me in the chat box. Are you finding the chapter easy? Are you finding the chapter easy or difficult? Please tell me in the chat box. Easy, easy. Very good answer. Okay, let's start illustration number 4. XYZ Limited is considering merger of ABC Limited with itself. So XYZ Limited is the bidder company and ABC Limited is the target company. Okay. XYZ Limited shares are currently traded at rupees 25. So MPS, the market price per share of XYZ Limited is rupees 200. It has 25,000 shares outstanding and its profit after tax amounts to rupees 5 lakhs. ABC Limited has 12,500 shares outstanding. Its current market price is rupees 100 and the profit after tax is 1,25,000. The merger will be affected by means of stock swap. Stock swap means stock exchange. ABC Limited has agreed to plan under which XYZ Limited will offer current market value of ABC Limited's shares. Okay. So guys, a hint is given to you for the swap ratio. A hint is given to you for the swap ratio. What is the hint? Hint is ABC Limited has agreed to a plan under which XYZ Limited, which is the bidder company, will offer the current market value of ABC Limited shares, which means the swap ratio is to be determined on the basis of market price per share. That is the hint which is given in this line. So the question might tell you directly that this is the way in which swap ratio is to be computed, like the one which we did earlier. Question is directly telling you that swap ratio is computed on the basis of EPS and MPS. Question is directly telling you, okay? But in this particular question isn't directly telling you. Question is indirectly telling you the method of computing the swap ratio. Indirectly. What is that method? Market price per share. So the question is indirectly telling you that market price per share is the method or is the way in which the new earning per share is to be calculated. That's an indirect way of telling you. Okay, sir, got it. What is the pre-merger earning per share? So first you need to compute the pre-merger earning per share and pre-merger P ratio of both the companies. Okay, this is easy. Then, if ABC Limited's P ratio is 6.4, what is the current market price? Okay, if you know P ratio is changed, it is 6.4, then what is the current market price? What is the exchange ratio? And what will be the X Limited's post-merger EPSB? So, you know, the question is asking you to compute the EPS on the basis of revised data also. First, the original data, part 1, original data. Then question is revising the PE ratio and you have to compute the answer as per the revised PE ratio. Okay, market price is required to be computed. Okay. What should be the exchange ratio of XYZ Limited's pre-merger and post-merger EPS are to be the same. Now, this is a catch, okay? This is a different, part altogether. We'll see about it. First, let's do 1 and 2. So, yes, question where you are given the data, a lot of data, a lot of metrics is given. The first thing is to create a table out of it, okay? So, let's create a table out of this data. And data is given to you for XYZ Limited and ABC Limited respectively. So what is the market price per share? Market price per share is 200 and 100. That is the market price per share. What are the number of shares? Number of shares are 25,000 and 12,500 for both of the companies. 25,000 and 12,500. What is the profit after tax? Profit after tax is given for both the companies. Yes. 5 lakh and 1,25,000. 5 lakh and 1,25,000. So guys, using this data, can we compute two things? Number one, the earnings per share, and number two, the PE ratio. Can we compute both the things? Yes, sir, we can compute both the things. Earning per share will be profit after tax divided by the number of shares. So 5 lakh divided by 25,000. EPS is 20. 12,500 divided by 10. So earnings per share is 20 and 10. Now what will be the PE ratio? PE ratio will be MPS over EPS. EPS we have already computed. MPS is given in the question. So MPS over EPS is the PE ratio. So 1 divided by 4. This is 10 times and this is also 10 times. 10 times and 10 times. So yes, the first part is answered. We need to compute the pre-merger earning per share and P ratio of both the companies. We have computed them. Okay. So hence the pre-merger P ratio and EPS of XYZ Limited is computed as rupees. So first of all, for XYZ Limited, the P ratio is 10 and the EPS is 20. Similarly, on the same lines, we'll write another statement where P ratio and the earnings per share is calculated for ABC Limited. It is again 10 times for ABC Limited and rupees 10 for the EPS. So is first part absolutely clear to all of you? Please comment in the comment section if first part is absolutely clear, because it's nothing, guys. It's very, very easy. So before the merger, P ratio is also given to you. Before the merger, EPS is also given to you. Okay, it's computed by you. Okay, both the things are computed. Yes, yes. Now let's get on to the second part. Now let's get on to the second part. The second part is saying if ABC Limited's P ratio is 6.4. Okay. Now the P ratio is changed only of ABC Limited, not of XYZ Limited. Please note the P ratio is changed only for ABC Limited and not XYZ Limited. So it is asking if the P ratio of ABC Limited is changed to 6.4 instead of 10, then what is the current market price? Okay. And what is the exchange ratio then? So this is the question that we need to answer. What will be the XYZ Limited's post-merger EPS? Post-merger EPS is also required to be computed. Okay. So computation of MPS if P ratio is 6.4. So you know P ratio is 6.4 and the earning per share of ABC is 10. Earning per share of ABC is 10. So the revised MPS of ABC will be 64. The revised MPS of ABC will be 64. 64 is the market price per share of ABC Limited. So what is the revised market price per share of ABC Limited? It's 64. Rupees 64 per share is the revised market price per share of ABC Limited. Now, it is asking you to also calculate the exchange ratio. Okay. What should be the exchange ratio? Again, exchange ratio is to be based on the basis of market price per share. Because the question has already hinted you that the exchange ratio will be on the basis of market values of ABC Limited shares. Okay. So we need to compute the exchange ratio on the basis of market price per share of ABC versus XYZ. Now the catch is that market price per share of XYZ, the bidder company is very clear, it's 200. Okay, so the market price per share of bidder company is very clear, it's 200. But now the question is, and the more point of consideration is, what should we take as the market price per share of ABC Limited? Should it be 100 or should it be the revised value of 64? What should be taken as the basis of calculation of the swap ratio in this case? We are confused because the question has given you a market price per share which is 100 and question has also asked you to compute another market price per share, revised market price per share 64. Which one should we take? Should we take the old market price per share or should we take the new market price per share? Guys, obviously, if the question has required you to revise the market price per share, you should take the swap ratio on the basis of a revised market price per share and not the old market price per share. So we'll have 64 over here, not 100, it should be 64. Unless until question tells me that, it needs only the old market price per share. If it tells me, then I will compute it as per the basis of the old, but otherwise we'll compute it at the basis of the new earnings per share. The new market price per share. New market price per share is 64. MPS of XYZ Limited is 200. So the swap ratio is 0.32 times. What is the swap ratio? Swap ratio is 0.32 times. Now I want all of you to compute the new earnings per share post the merger. This you should compute yourself. I'll give you 2 minutes. Compute yourself what is the new earnings per share. That is what you need to compute. We need to compute the new earnings per share. Guys, you compute the new earnings per share. I am not computing the new earning per share. You compute the new earning per share and give me the answer. And yes, swap ratio is to be computed on the basis of the new swap ratio. Okay, swap ratio should be this. Please compute the answer. Take 2 minutes, but compute the answer. I want all of you to compute the answer. Take 2 minutes, but compute the answer. And those students who have done the second part, they should try the third part. Good answers? Very good answer. Simple calculation. All right. Very good. Good that you tried yourself. Okay. So 5 lakhs plus 1,25,000. There is no synergy benefit as such. 1,25,000 divided by number of shares, number of equity shares. 25,000, 12,500. 25,000 plus 12,500 multiplied by 0.32. 12,500 multiplied by 0.32. So 12,500 multiplied by 0.32 plus 25,000. 29,000. So 6,25,000 divided by 29,000 gives me a figure of 21.55. Very good answer by all of you. Very good answer. 21.55. Hence the market price per share of ABC Limited is computed as 21. No, this is a new earning per share. Market price per share is 64. Market price per share is 64. Share exchange ratio is computed as 0.32 times. And the post-merger earning per share is 21.55 per share. Computation of exchange ratio is pre-merger and post-merger EPS are to be the same. Now, yes. Now there is a catch, okay. So second part is also done. Second part is also dusted and second part is also confirmed. Now we move on to the third part, and third part is little critical. You need to really be with me while we are discussing the third part. Third part is what should be the exchange ratio if the XYZ Limited's pre-merger and post-merger EPS are to be the same. We need the post-merger and pre-merger EPS to be the same. If pre-merger and post-merger EPS are required to be the same, then what should be the exchange ratio? We need an exchange ratio where the EPS doesn't change. Okay. So the existing EPS of obviously the XYZ Limited company, the bidder company, the existing EPS is 20 rupees. Okay. The existing EPS is 20 rupees. The new EPS is 21.55. We don't want this change to happen. The ask is, the requirement is that we don't want this change to happen. Ideally, this change should not happen. The old EPS should be the new EPS. Okay, 20 should be the new EPS. We don't want EPS to change. We don't want EPS to even increase. We don't want that to happen. What should be done if we want the new earning per share to be equal to the old earning per share? What should we do in that case? Okay, a very simple way of solving such question is assume the share exchange ratio, the new share exchange ratio to be X. We assume the new share exchange ratio to be X. Okay, so we let the expected exchange ratio be n times. We assume that the new earning per share, the new swap ratio is n times. Okay, so earning of XYZ Limited plus earning of ABC Limited plus synergy benefit divided by number of shares of XYZ multiplied by number of shares plus number of shares of ABC multiplied by the swap ratio. Okay, so earning of XYZ Limited is 5 lakhs plus earning of ABC Limited is 1,25,000 divided by number of shares of XYZ Limited. Number of shares of XYZ Limited is 25,000 plus number of shares of ABC Limited. Number of shares of ABC Limited is 12,500. Number of shares of ABC Limited multiplied by the swap ratio. The swap ratio is N or X, whatever you have assumed it. Okay, N or X, whatever you have assumed it. And the catch is we will equate this by 20. The existing EPS. We want our new EPS to be equal to the existing EPS. That is the ask, right? We want our new EPS to be equal to the existing EPS. So we'll equate this equation to 20 because we want our EPS to be the same in both the situations. So earning per share has to be the same in both the situations. So we equate our old EPS with our new EPS. So the new EPS is also 20. Okay, now we solve this equation to compute our swap ratio or the exchange ratio. Okay, sir. So it gives me a figure of 5 lakh plus 1,25,000 is 6,25,000. 6,25,000 is equal to, we take this entire denominator on the other side of the bracket. So 20 multiplied by 25,000. This gives me a figure of 5 lakh rupees plus 12,500 multiplied by 20 gives me a figure of 2,50,000 N. Okay, so we have 1,25,000 is equal to 2,50,000 N. So the share exchange ratio is 0.5. Did you understand this step, guys? Very, very important. Did you understand this step or not? Please tell me, did you understand this step or not? This is a very, very important step which you need to really understand. Did you understand this step or not? Please just delve into it. All right. Yes, we understood the computation. Yes, we did. 0.5 times is the new earning per share. Now, this will result into, if you have new earning per share of 0.5, then this will result into, if you have the swap ratio as 0.5, this will result into a new earning per share of 20. Now, let us also compute the new earning per share just for our satisfaction, just to see whether it is 20 or not. Let us compute the new earning per share using 0.5 as the swap ratio. 1,25,000 divided by 25,000 plus 12,500 multiplied by 0.5. Let's compute the new earning per share using swap ratio as 0.5. So 12,500 yes, this gives me a swap ratio of 20 only. Hence proved, guys, hence proved. Hence proved. So the new earning per share is 20 and the swap ratio which is to be taken as 0.5. Let us write the conclusion. Let us write the conclusion. Just write, hence the share exchange ratio should be, hence the share exchange ratio should be 0.5 times so as to yield, hence the share exchange ratio should be 0.5 times so as to yield same EPS post merger, so as to yield same EPS post merger as pre merger for XYZ Limited. So as to yield same EPS post merger as pre-merger for XYZ Limited. So to have the same earning per share post merger and pre-merger, the share exchange ratio should be 0.5 times. The share exchange ratio should be 0.5 times. That is how, whenever the question is asking you to compute the share exchange ratio, that is how you need to really write your answer, and that is how you need to compute it. Okay sir, got it. Okay, is the answer absolutely clear to all of you? Can we move to the next question? Because now we'll be escalating our level of our questions. We'll enter into more difficult kind of questions. Okay, we'll be escalating the level of our questions. Yes, very good, perfect. Let's start illustration number 5. Illustration number 5. Perfect Precision Limited has adopted a strategy of inorganic growth. Inorganic growth means merger and acquisition. Okay, so Perfect Precision Limited is actually, that means the bidder company, because it is inorganically growing. So Perfect Precision is the bidder company, and as consequence it always is look out for a soft target to be acquired. Recently the company has identified Exact Precision Limited as the target company. So which is the target company? Which is the target company? Target company is Exact Precision Limited, and the concerned team are working on this acquisition. Some of the financial data collected by the team is given below. So the financial data is given below for the Perfect Precision Limited and Exact Precision Limited. This is the bidder company, Perfect Precision is the bidder company, and Exact Precision is the target company. Now earnings per share is 750 in case of Perfect Precision. In case of Exact Precision, it is 5 per share. Earning per share is 7.5 and 5. Market price per share is given as 80 and 35 in case of Perfect Precision and Exact Precision respectively. Market price is also given to you for both the companies. Number of shares is given as 100 and 25 for Perfect Precision and Exact Precision respectively. So all the data is given to you, and guys, fortunately the data is already arranged in a tabular format. So I need not arrange it again in the tabular format. It's already in the tabular format. That's a very good advantage of how the question is presented itself. Now, it is expected that there may be a synergy gain of 5%. Oh, in this question, there's a synergy benefit. There's an additional profit which is given to you of 5%. Assume that you are one of the members of the concerned team and are requested to determine the exchange ratio if Perfect Precision Limited wants to have a post-merger earnings per share of rupees 6. Oh, now in this question, again, a reverse calculation is required to be done. You are not given the exchange ratio, guys. You are not given the exchange ratio. You have to compute the exchange ratio. You have been given the new earnings per share post-merger. What is the new earnings per share post-merger? 6. On the basis of a reverse calculation, you need to compute the swap ratio. Very, very interesting question and an examination question. So let's compute the share exchange ratio to yield an EPS of rupees 6. Of course, we'll let the share exchange ratio be n times. Let the share exchange ratio be n times. We write the entire formula. Earnings of the bidder company plus earnings of the target company plus synergy benefit divided by number of shares of the target company multiplied by the swap ratio and earning per share of the bidder company. We write the entire formula. Okay. Let the share exchange ratio be n times. Okay. Okay. Let's form the equation. So 6 is the new earning per share, which should be equal to earnings of Perfect Precision Limited. Total earnings is required to be calculated. So total earnings means 7.5 divided by 100. 7.5 divided by 100. So it is 750. It is 750. Okay, crores. The amounts are given in crores. So this is in crores. Okay. So 750 plus 5 multiplied by 25. It's 125. 750 plus 125 plus. There's a synergy benefit of 5%. So post merger there will be a synergy benefit of 5%. 5% additional profits will be accrued to you. Now whenever this kind of information is given to you, then you always add the individual profits and you multiply it by 5%. Add the individual profits and multiply it by 5%. That is the way you should do it. Number of shares of Perfect Precision Limited, it's 100 number of shares of Exact Precision Limited is 25 multiplied by N. N is the times in which the swap ratio is computed. Swap ratio is computed as N times. Okay. So we simplify this answer. So 600 plus 6 into 25, 150N is equal to 750 plus 125 plus 43.75. Okay, so this gives me a figure of 150N is equal to 918.75 minus 600. 50 plus 125 plus. Okay, so N is equal to, you just have to solve the equation, guys. Please solve the equation. 318175. And compute the swap ratio. Let's see if you can compute the swap ratio yourself. Let's see if you can compute the swap ratio yourself. N, what is the value of N? Let's see if your computation, is perfect. It's all about computation, that's it. Once your formulas are in place, once you have written the new earning per share and the entire formula, then it's all about computation. And one error in computation, one decimal here and there, and your entire answer will go for a toss. So I want to see who computes the correct answer in this particular case. I want to see your answer. Let's see in the chat box if someone gets it right. What is the exchange ratio? Anyone? What is the exchange ratio? Oh, perfect answer. Very good answer. Very good answer. Perfect answer. 2.25 times. Yes, very right answer, guys. Very good answer. Hence, the share exchange ratio to be kept to yield an EPS of ₹6 post merger is 2.125 times. And number of shares to be issued to shareholders of Exact Precision Limited is, how many shares are to be issued to Exact Precision Limited? Let's also find that 25 multiplied by 2.125 times. 25 multiplied by 2.125 times. So it is 2.125 multiplied by 25 gives me a figure of 53.125 crore shares. 53.125 crore shares. These are the shares to be issued to the shareholders of Perfect Exact Precision Limited. Exact Precision Limited is the target company. Perfect Precision Limited is the bidder company. Guys, the most important part of these questions is to get a hold of the data which is given in the question. That's the biggest part. If you get a gist or you get a hold of the data which is given in the given in the question, then you've done it. You've played the trick. So that is the most important part, that you need to get a hold of the data which is given in the question. That's very, very important. Data is of critical importance in this particular case. Okay, please let me know if your should we move ahead? Is the answer absolutely clear to all of you? Is the answer absolutely clear to all of you? Okay. Yes, sir. Let's move further. Can I move to my next topic? Yes, sir, we can move to our next topic. Perfect. Okay. So guys, in our earlier questions, we had seen that sometimes bidder wants the earning per share to be same as the previous earning per share. So if the previous earning per share is say 20, the bidder wants that the new earning per share should also be 20. Many times the bidder wants that your new earning per share should be equal to the old earning per share. We don't want an increase or a decrease in earning per share. Earning per share should be constant, because bidder is worried if earning per share is increased or decreased, then shareholders' expectations vary. So bidder is worried. Bidder doesn't want a major shift in the earnings per share. Bidder wants that the earning per share should be equal to the old earnings per share. We have a very simple solution to that. We'll just write our entire formula. New earning per share is equal to earnings of bidder plus earnings of target divided by number of share of bidder plus number of share of target multiplied by the swap ratio. We have that formula. We put the new earning per share as the old earning per share, and our answer is solved. Our answer is done. We have a very straightforward approach to the entire concept. Now there's another catch to the question which examiner can give you, and this time the examiner can ask you to keep earnings as the same as the earlier earnings. Sir, what do you mean? EPS being the earlier EPS, but this time it's not the EPS, it's the earnings which are required to be the same. Is the earnings which are required to be the same. This time it's not the EPS which is required to be the same. EPS may vary, earning per share may vary, but the bidder company wants that the shareholders' earnings which were there before the merger, they should be same as the earnings after the merger. That should be the same. The earnings should be the same. Now what should be done if we want the same earnings to be there? This time it's not about EPS. Please understand the difference. Some students get confused in the examination, right? They don't observe this word. You have to keenly, minutely observe this word. Whether the examiner is asking you to keep the EPS as same, or whether the examiner is asking you to keep the earnings as same. Earnings means total earnings, EPS means per share earnings. And both have different approaches to it. Both have absolutely different approaches to it. Okay, let me demonstrate. Okay, there are two companies A and B. Number of shares of A is 10,000, number of shares of B is 8,000. Profit after tax of A is 2,50,000. Profit after tax of B is 2 lakhs. Okay, so the existing earning per share of A and B is 2,50,000 divided by 10, 25. 2 lakh divided by 8,000, 25. Okay, by chance the EPS is also the same. Okay. So now this time the question will ask you, the examiner will ask you, you have to keep the earnings as same. Earnings pre-merger should be equal to the earnings post-merger. And whenever this examiner gives you this point, then you have to always take the swap ratio on the basis of EPS. Then your earnings will be the same. You always take the swap ratio on the basis of EPS, earning per share. That should be the basis that you should compute for computing the swap ratio. I'll demonstrate, okay. Let's compute the new earning per share of this particular organization. New earning per share will be old earning per share. There's no synergy benefit. We are ignoring synergy benefit. Okay. The old earning per share divided by number of shares of A Limited, which is 10,000, plus number of shares of B Limited, which is 8,000, multiplied by the swap ratio on the basis of EPS. Swap ratio on the basis of EPS, which is 25 over 25, which is the same. So the new earning per share will be the same. Okay, so the new earning per share is calculated as, it will actually be the same. So guys, let's change the numbers a little bit, because everything is coming out to be the same. So the number of shares of B Limited is 1,50,000. Number of shares of B Limited is 1,50,000. Okay. No, PAT of B is 1,25,000. 1,50,000. Okay. So 1,50,000 divided by 8,000. This is 18.75 is the earning per share. Let's change numbers a little bit, because everything will turn out to be the same. So we have 2,50,000 plus 1,50,000, 2,50,000 plus 1,50,000, and we have the swap ratio also on the basis of the existing earning per share. This is the target company. This is the bidder company. Okay. Now we take the swap ratio on the basis of existing EPS. 18.75 divided by 25. So 8,000 multiplied by 18.75 divided by 25. Okay. So the answer is new earning per share is computed as 25. Just see the new earning per share. New earning per share is computed as 25. New earning per share is computed as 25. But sir, tell us one thing. The old earning per share was 18.75. New earning per share is 25. There's a difference. You know, from point of view of target company, there's a difference in earning per share. Yes, earning per share will be different. The examiner has asked you to keep the earnings as the same. Earnings are to be the same, not the earning per share. In this question, earning per share will be different, but the earnings will be the same. And I'll prove you how earnings will be the same. Okay. So, what are the earnings of B Limited pre-merger? Earnings of B Limited pre-merger is 1,50,000. Okay. And earnings of B Limited post-merger? Earnings of B Limited post-merger? Post-merger, the number of shares of B Limited will be 8,000. 6,000. 6,000 multiplied by 25. 6,000 multiplied by 25 is the new earning per share. So the post-merger earning is also 1,50,000. And this is how the earnings will be the same. Now you need to really minutely observe what is the ask of the question. If the question is asking to keep the earnings per share as same, then you have to, in this formula, replace a new earning per share by the old earning per share. That is what you need to do in this particular formula. And if the question is asking you to keep the earnings as the same, then simply you need to compute the swap ratio on the basis of existing EPS. That's how the earnings will be the same. See, these earnings are the same. 1,50,000, 1,50,000 total earnings are the same of the shareholders of the target company. So now, you need to really observe in the question, what is the requirement? Is the requirement to keep the EPS same, or is the requirement to keep the earnings the same? Okay. Okay, sir, got it. Now let's read the next topic. When pre-merger and post-merger earnings, not the EPS, okay. Now we need to equate the earnings of post-merger and EPS of the shareholders are to be maintained at the same level. In case the question asks to equate or ensure that post-merger earnings and pre-merger earnings of the shareholders are to be kept the same, the swap ratio should be taken on the basis of EPS. The swap ratio is to be taken on the basis of EPS. This ensures that shares are exchanged on the basis of differential in EPS, and hence the total earnings available to the shareholders remain constant. So the total earnings remain the constant in this particular case. So when you want the total earnings to be the constant, then you keep the earning per share as the same. Earning per share post-merger, earning per share pre-merger. Not earning per share. The swap ratio is to be taken on the basis of earning per share. The swap ratio is to be taken on the basis of earning per share if earnings are to be equated. And if earning per share is to be ensured that it should be the same, then you just replace NEPS by the old EPS. So this is a difference between the question, very minute difference, and you have to really observe in the question whether earnings are to be equated or earnings per share are to be equated. Okay, sir, let's do one question and you will be able to understand what am I saying. So X Limited is intending to acquire B Limited. So X Limited is the bidder company. B Limited is the target company. And the following information is available in respect of the companies. Information is given to you for X Limited and B Limited. X Limited being the bidder company and B Limited being the target company. And I love the examiner when it gives me information in a tabular format. I love it. Because then I don't need to convert it into a tabular format. So this is the best format the examiner can help me out with, okay. So number of equity shares of X Limited is 5 lakhs, number of equity shares of B Limited is 3 lakhs. Earnings after tax is 25 lakhs and 9 lakhs respectively. Market value per share is also given to you, 21 and 14. The first task is to compute the present EPS. You need to compute the existing EPS. Very simple. This divided by this divided by this. Very simple. Current EPS is computed in that manner. Okay. If the proposed merger takes place, what would be the new EPS for X Limited? Assuming that merger takes place by exchange of equity shares and the exchange ratio is based on the current market price. So swap ratio is given to you. Swap ratio is to be taken on the basis of market price. You need to compute the new earnings per share. What will be the new earning per share? The swap ratio is taken on the basis of current market price. That is the second ask. Okay, sir. What should be the exchange ratio if B Limited wants to ensure that same earnings to the member as before merger takes place? So B Limited wants that my earnings should be the same. The total earnings of B Limited should be the same. I don't bother about EPS. EPS may change, but the total earnings should remain the same. B Limited wants that. Then what should be the exchange ratio? So please be very, very careful. What is question asking you to equate? In this question is asking you to equate the earnings, not the EPS. Many students make this mistake. They would replace the new EPS by the old EPS and the question goes for a toss. It's wrong. The answer is wrong. Okay, sir, got it. Okay. If you understood this difference, okay, this is just a difference. Please comment a yes in the comment section if you understood this difference. This difference is very, very important to be understood. And of course, once we do this question, you will be able to further understand it well. Okay. Okay, first, easy things first. Let's compute the earnings per share, total earning divided by the number of equity shares. Let's see what is the total earnings. $5 lakhs, 3 lakhs. Earnings after tax, 25 lakhs, 9 lakhs. So what is the earnings per share? 5, 3. This is the existing earnings per share. Earning per share is 5 and 3. Okay, so earnings per share of A Limited, of X Limited and B Limited is computed as 5 and 3 respectively. So the existing number of shares, the existing EPS is computed in this manner. This is the existing EPS. The present EPS is given to you, 5 and 3. Now, the next is we have to compute the NEPS, the new earnings per share, on the basis of MPS. The swap ratio is taken on the basis of MPS. We need to compute the new earnings per share. All right. So NEPS is equal to PAT of X Limited plus PAT of B Limited plus the synergy benefit whole divided by shares of X Limited plus shares of B Limited multiplied by the swap ratio. So what is the PAT of X Limited? Earnings after tax, 25 lakhs. 9 lakhs is the earnings after tax of B Limited whole divided by number of shares of X Limited, which is 5 lakhs. Plus 3 lakhs is the number of shares of B Limited multiplied by the share exchange, the share exchange ratio. Share exchange ratio should be on the basis of MPS, market price per share. What is the market price per share? 14 and 21. 14 and 21. 14 and 21. So what is the new earnings per share? New earnings per share is 4.86 per share. So what is the new earnings per share? New earnings per share is 4.86 per share. I hope you also computed the same answer. Please comment in the chat box if you computed the same answer. $4.86 per share. Now the last part is asking you to equate the earnings. The same earnings is required post merger and pre merger, and to ensure the same earning, the exchange ratio should be on the basis of EPS that we already are aware of. Okay, so the new earning per share will be, now I'm not writing the formula again. Okay, I'm not writing the formula again. We'll use the same figures, 25 lakh, 9 lakh, 5 lakh. So 25 lakh plus 9 lakh whole divided by 5 lakhs plus 3 lakhs multiplied by, on the basis of EPS, the share exchange ratio is required to be computed. 3:5. 3:5. Okay. So what is the new earnings per share? The new earnings per share will be the new earning per share is rupees 5. What's the new earning per share? The new earning per share is rupees 5. Yes, very good. New earning per share is rupees 5. Okay, now we have to prove that earnings of B Limited post merger and pre merger will be the same. We have to prove that. Okay, to prove that, I will simply compute the earnings post merger and pre merger. Pre merger earnings is 9 lakh rupees. 3 lakh multiplied by 3. It's 9 lakh rupees. Okay, 3 lakh multiplied by 3. And post merger earnings is 5, and how many shares are there? 1,80,000 shares are there. 1,80,000 shares are there. So the new earnings is 9 lakhs. Hence, to ensure the same earnings to the members of B Limited, we need to keep the EPS. We need to keep the swap ratio on the basis of EPS. The swap ratio should be on the basis of EPS. Okay. Now you have to identify in the question whether the question is asking you to keep the earning per share as the same, or whether the question is asking you to keep the earnings as the same. You need to really see in the question itself. Yes, please comment in the chat section if you understood the answer well. And yes, you can copy the answer. Okay, we know very minute points, minuscule points can change the entire answer. Can either get you full marks, or either can get you 0 marks. So either ways it's possible. All right. Okay. Let's start illustration number 7. Longitude Limited is in process of acquiring Latitude Limited. So Longitude Limited is the bidder company. Latitude Limited is the target company. On a share exchange basis, of course, swap is happening. Following data are available. Data is given to you, profit after tax is given to you, number of shares in lakhs is given to you, earnings per share is given to you, and price earning ratio is given to you. Ignore the synergy effect. Perfect. You are required to calculate the pre-merger market value per share. So first of all, we want the pre-merger market value per share, which is nothing but a multiplication of EPS and PE ratio. We just multiply EPS and PE ratio, we'll get the market value per share. So guys, in our minds, we are also contemplating the answers simultaneously as we are reading the question. Okay. What is the maximum exchange ratio Longitude can offer without dilution of EPS? Now, EPS is to be remain the same. We need same EPS post-merger as pre-merger. We don't want dilution of EPS. So, what is the exchange ratio if you don't want to dilute the EPS? Second, we don't want to dilute the market value per share. What should be the exchange ratio? This we have not done as yet. This is a new concept to us. Okay, we'll see how we have to do it. Calculate the ratios up to 4 decimal points and the amounts and number of shares up to 2 decimal points. So, the ratios are to be calculated up to 4 decimal points and the amounts and number of shares up to 2 decimal points. That's the instruction which is given in the question, which we will follow. Okay, sir. So, first of all, we need to compute the MPS, market price per share, pre-merger, P ratio multiplied by the EPS, simple as it is. Okay. So, 8 multiplied by 15, 15 multiplied by 8. Then we have 10 multiplied by 5. So 15 multiplied by 8 and we have 10 multiplied by 5. So what will be the answer? This is rupees 120 and this is of course rupees 50. That's the pre-merger market value. Okay. Now the second question is you have to compute the exchange ratio if you want the same EPS. Now please remember, they don't want the same earnings, they want the same EPS. They don't want the same earnings, they want the same EPS. So the old EPS is to be taken as the new EPS. That's the point. Okay. What is the old EPS? Old EPS is 8, and always bidder companies old EPS is equated. Okay. So the old EPS is 8. So we need 8 as the new EPS also. Okay, sir. So just conclude the answer. 8 to 120 and 50 per share is the post-merger MPS. Pre-merger MPS, sorry. Pre-merger MPS is given to you. The pre-merger MPS. Okay, so we determine the maximum exchange ratio. So what should be the maximum exchange ratio? Maximum exchange ratio without dilution of EPS. We don't want our EPS to be diluted. Alright, use the same formula. NEPS is equal to PAT of longitude plus PAT of latitude plus synergy benefit whole divided by equity share of longitude. Okay, we need to write one line also over here. Okay, let the swap ratio be x times. Let the swap ratio be x times. So equity share of longitude plus what is the profit after tax of longitude? $140 and $60. 140 plus 60 divided by equity shares of longitude. It is 15 and 16. Okay. 15 plus 16 into x is equal to the old earning per share. Old earning per share is 8. What is the old earning per share? Old earning per share is 8. So all these numbers are in lakhs. All these numbers are in lakhs. Yes, sir. We need to compute the exchange ratio, and you will compute the exchange ratio, guys, this time. You please compute the exchange ratio. What should be the exchange ratio? You need to compute it. I'm not giving you the answer. You have to compute the exchange ratio yourself. I'm not giving you the answer. What should be the exchange ratio? You have to go. Very good answer. Perfect answer. Very good answer. Good, good, good. I like it. It's 200 is equal to 120 plus 128x. So x is equal to 0.0625. So exchange ratio is equal to 0.625 times. Okay, let's write the conclusion also. Hence, the exchange ratio, hence the maximum exchange ratio without diluting the EPS is computed as 0.625 times. Hence, the maximum exchange ratio that can be offered without diluting the EPS is computed as 0.625 times. Okay, got it. Now the second part. Second part is a little tricky. If all of you understood the first part, please write a yes in the chat box, because second part is a little tricky. I don't want to rush into the second part before you have not understood the first part. So first, please confirm whether you understood the first part or not. Then I'll move on to the second part. Did you understand the first part? Please write a yes in the chat box, then only will I move to the second part. Perfect. Yes, yes. Very good. All the students. Okay. Very good. Very good, guys. Okay. Now is the critical question. Okay. The critical question is, now we need to compute the maximum exchange ratio Longitude Limited can offer without diluting of the market value per share. Now we want the old market price per share to be equal to the new market price per share. So the old market price per share pre-merger should be equal to the new market price per share pre-merger, post-merger. That's the requirement. What is the old market price per share? The old market price per share is computed as rupees 120. This is the old market price per share. We need the new market price per share to be 120. We need it the same. We need to correlate both the things. How can we do that? Let's see how can we do that. Okay. So, computation of maximum exchange ratio without dilution of market price per share. What does it mean? It means that market price per share pre-merger is equal to the market price per share post merger. These two things should be equal. Market price per share pre-merger should be equal to the market price per share post-merger. Alright. Now, market price per share pre-merger is 120. Right? Right. Now, what is market price per share post-merger? This market price per share post-merger is to be calculated using a formula. Okay. What is the formula? Market capitalization of longitude post merger plus market capitalization of latitude. Latitude will be merged into longitude, okay? Post merger whole divided by number of shares of longitude plus number of shares of latitude multiplied by the swap ratio. Did you understand this entire formula? I have not picked this formula from anywhere. I've just made it in my mind, okay? So we need to compute the MPS post merger. So market capitalization of longitude post merger plus market capitalization of latitude post merger divided by number of shares of longitude plus number of shares of latitude multiplied by the swap ratio. Now I'm assuming one important thing. Let the swap ratio be x. Let the swap ratio be x. Okay. So now we'll compute the market capitalization of longitude post merger. What will be the market capitalization of longitude post merger? Post merger, the market price is to be the same. It is to be 120. Post merger market price should be 120. That is the ask. That is the requirement. Okay. Now, what is the number of shares of longitude? It is 15 lakh shares. Okay. So 15 lakh shares multiplied by 120 is the market capitalization post merger of longitude. Now we need the post merger market capitalization of latitude. What is the post merger capitalization of latitude that we need now? Okay. So you know the latitude limited will merge with longitude limited. Okay. So what is the market capitalization of latitude limited? Latitude limited existing number of shares is 16. Latitude limited existing number of shares is 16 and latitude's existing market price. What is the existing market price of latitude? Is 50. Okay. Latitude's existing number of shares is 16 lakhs and latitude market price per share existing is 50 lakhs. If I multiply both of them, 16 multiplied by 50, I will get it as 800 lakhs. Okay, this is 800 lakhs. Latitude's existing capitalization is 800 lakhs. Okay, so you know, assuming that we give the same capitalization to the latitude limited currently as well. So the number of shares of latitude is 16 and the market price per share is 50. 16 and 50. So plus 16 multiplied by 50. Plus 16 multiplied by 50 divided by number of shares of longitude limited. Number of shares of longitude limited is 15 plus number of shares of latitude limited will be 16 multiplied by x. Number of shares of latitude limited will be 16 lakhs multiplied by x. So we want the market price per share to be the same post and pre-merger. We want that to happen. So what we have done is we have capitalized, we have computed the market capitalization of the old entities. We have combined both of them together. And you know, assuming that there's no synergy benefit that is given in the question, there's no synergy benefit. Okay. Since synergy benefit is not there, we have not added anything extra. We have considered that the existing values of the old companies will remain the existing value of the new companies. Okay. So both of them will be the same. Okay. There's no synergy benefit which we have added to this computation. Now we will calculate the share exchange ratio. And this shall be equal to 120. Okay. This implies that $1,800 plus 16 into 50, which is 800. So what is the share exchange ratio? Share exchange ratio is calculated as 0.4167. Share exchange ratio is given as 0.4167. What is the share exchange? No, 4 decimal places are required to be computed in case of share exchange ratio. 4 decimal places, up to 4 decimal places it is required to be computed. And yes, the answer is 0.4167. The share exchange ratio should be 0.4167. So yes, we can again write the conclusion. Hence, the maximum share exchange ratio to be offered without dilution of MPS, is computed as 0.4167 times. 0.4167 times. This is the maximum exchange ratio that can be offered without dilution of MPS. Okay. Please let me know if you understood the entire concept and the formula. Formula is also important. Something new that we have done, apart from EPS equalization, we have done MPS equalization also. MPS is to be the same. Okay. So now this is the answer. Now there's one catch in this question. There's one error in this question. Actually, it's an error. Okay. So this question came in the examination also, but there was an error in this question. What is the error? Let me tell you. EPS is given to us as 8. Okay. However, if we calculate EPS using the two figures 140 divided by 15, the EPS is coming as 9.33. That's the error in the question. This is not what we have taken. Okay. 60 divided by 16, the EPS is to be 3.75. That's an error in the question which came in the examination as well. Okay. So these computations don't tally. So the examiner had written a comment that since in the question figures given for PAT of both the companies are not matching with the figures of EPS multiplied by number of shares, hence if students computed PAT by using the formula, then alternative answer will be correct. So if you compute the PAT by multiplying if you use the PAT and you then compute the EPS, then that answer will also be correct, because there is an error in the question. Therefore, this note was given in the answer, but in the examination, guys, this error will not creep in. Okay. This is an error which is there in this particular question. It will not be there generally in the examination. So that's, you should rest assured about that. All right. So yes, guys, we had developed our understanding of the swap ratio to a very high extent today. We have computed the new earning per share also. We have computed the swap ratio in various circumstances also. So a great level of detailing we have done in our today's session. And I expect you to cover this entire concept by yourself before we come on to the next class, so that, because in the next class I'll be escalating the concepts to a very, very high level to understand those concepts. These concepts should be absolutely ingrained in your memory, should be ingrained in your ecosystem. So yes, before the next class, please do all these questions in writing in your register clearly, with presentation, with format, with headings and conclusions, etc., etc. So that's the expectation which I have from all of you. And yes, on that positive note, all the very best and happy studying. We'll meet in the next session.